Hi, my name is Neil Saunders and welcome to this week's edition of Retail Perspectives. What I'd like to talk about this week is the housing market, because it's one of those areas of the economy where we're seeing some really positive movements at the moment. Now, part of that is down to the fact that consumer confidence is improving, so more people are looking at moving home. Some of it's partly down to the government schemes such as Help to Buy, and some of it is also down to the fact that there is still a huge underlying demand for housing. All of those things have helped over recent months to boost the market. So we're seeing a rise in the number of transactions, and we're also seeing, especially in the southeast, some fairly sharp rises in prices. Now, the housing market's interesting because it has a very direct and indirect relationship with retail depending upon how you look at it. The direct part of the relationship is that if you have more transactions, if more people move home, that naturally gives a boost to some of those sectors that are very directly linked to homes. So things like DIY, furniture, floor coverings, electricals, all of those areas receive a positive boost from people moving house. The indirect part of the relationship is more about confidence. Because as prices rise, those people who own their homes feel that their assets have been inflated, and that gives them a little bit more confidence perhaps to go out and spend. Now, interestingly, before the downturn, that confidence to go out and spend was also matched in monetary terms by people withdrawing equity from their homes. So as the value of their house increased, people remortgaged and took some of that money and spent it, among other things, on retail. And that, before the recession, gave retail a really nice boost. Now, unfortunately, it doesn't look like that part of the market is going to come back. Housing equity withdrawal still remains quite low, and lots of people are still focused on paying down the mortgage debt. So rising house prices may boost confidence a bit, but they're not going to put a lot more money into the retail economy. However, the positive news is that on the transaction front, that direct part of the relationship, we are starting to see some of the increased transaction levels filtering through into better numbers from the sectors that are related to it. So if you look, for example, at DIY, this year we're predicting DIY will shrink by about 3%. Next year, partly because of the increase in housing transactions, we expect DIY will grow by about 0.4%. Now, that sounds quite anemic growth, but when you think DIY has been in shrink for a very long run period of time, since before 2008, actually a resumption of positive growth is a very big step forward. Electricals is similar. This year it shrunk by about 2.5%. Next year, partly because of the increase in housing transactions, we think that the market is going to grow by about 0.8%. Again, fairly flat growth, but growth has resumed. And furniture and floor coverings, which has really suffered during the downturn, and we've seen many casualties in that sector as well as falling sales, will move from position this year of probably being down by about 0.9% in terms of growth to growing by about 1%. So that's actually resuming some much more robust levels of increase as we move forward. And of course, as the housing market improves and strengthens, all of these sectors will grow more strongly and they will pick up in terms of the number of people buying things. So the housing market is key for all of those home retail sectors. And the outlook for the next 5 years, whilst it isn't as rosy as it was pre-recession, is certainly much better than it's been since 2008 and the onset of the downturn.